Listen, I need to tell you about something that's been keeping me up at night. And at 95 years old, not much keeps me up anymore. I've been watching three sectors of the American economy that are about to go through transformations so massive, they'll create fortunes for people who position themselves correctly. And I'm not talking about some far-off future. I'm talking about the next 5 to 10 years. Now, I know what you're thinking. Warren, you're always cautious. You're sitting on $325 billion in cash. What do you mean you're betting on anything? Here's the thing. I'm cautious about valuations, not about America. I'm cautious about overpaying, not about opportunity. And right now, in these three specific sectors, I see the kind of opportunity that only comes along once every couple of decades. So for the next minutes, I'm going to walk you through exactly what I'm seeing, why these sectors are set up for explosive growth, and how I'm thinking about positioning Berkshire and how you might think about your own investments. But first, let me be clear. This isn't financial advice. I'm showing you my thinking. You need to do your own analysis and make your own decisions. Got it? Good. The energy transformation, the biggest infrastructure build in history. Let me start with the sector that most people are completely misunderstanding, energy infrastructure. Now, when most people hear energy, they immediately think about oil and gas versus solar and wind. They think it's a political debate, liberal versus conservative, green versus traditional. That's all nonsense. This isn't about politics. This is about math. Here are the facts. America's electricity consumption is about to explode. And I don't mean grow gradually. I mean explode. Every single trend in our economy requires more electricity. Artificial intelligence data centers, they consume as much power as a small city. Electric vehicles, every EV that replaces a gas car increases household electricity demand by 30% to 50%. Manufacturing coming back from China, factories need massive amounts of power. The consulting firm Grid Strategies estimates that electricity demand will grow 15% to 20% by 2030. That might not sound like much, but consider this. Electricity demand in America has been basically flat for 15 years. We've gotten more efficient. Now suddenly, we need 15% to 20% more capacity in 6 years. Here's the problem. Our electrical grid is old. Most of it was built in the 1960s and 1970s. It wasn't designed for this kind of load. It wasn't designed for distributed solar power feeding back into the grid. It wasn't designed for the kind of reliability that data centers demand. We need to rebuild the entire thing, and that's going to cost somewhere between $2 trillion and $3 trillion over the next 20 years. Now, who's going to do this work? Regulated utilities. Companies like my own Berkshire Hathaway Energy, Duke Energy, NextEra Energy, Southern Company. Here's why I love this sector. It's boring, it's predictable, and it's profitable. These companies operate as regulated monopolies. They're allowed to earn a fixed return on their invested capital, usually around 9% to 10%. They invest money building infrastructure, and regulators let them charge customers rates that give them that return. So the business model is simple. The more you invest in infrastructure, the more you earn. And we're about to enter the biggest infrastructure investment cycle in generations. Think about what this means. If a utility invests $10 billion in grid upgrades, they get to earn 9% to 10% on that $10 billion every single year, essentially forever. That's $900 million to $1 billion in annual earnings from that one investment. And they'll be making these investments for the next 20 years. Now, utilities aren't exciting. The stocks don't double overnight. But they pay dividends around 3% to 4%. They grow earnings at 5% to 7% annually. And they're as reliable as the sunrise. Over 10 or 20 years, you're looking at total returns of 8% to 11% per year, with very low volatility. In a world where I can't find many things to get excited about, that gets me excited. But it's not just utilities. The entire energy infrastructure ecosystem is going to benefit. Natural gas pipeline companies will see demand surge because natural gas is the backup fuel for renewable energy. When the sun's not shining and the wind's not blowing, you need natural gas power plants to fill the gap. Electrical equipment manufacturers, companies that make transformers, switchgear, transmission lines, they're going to be running at full capacity for years. Even the companies that make the equipment for utility trucks are going to benefit. This is a complete ecosystem play. If I were building a portfolio today, I would have 20% to 25% in energy infrastructure, split between regulated utilities, pipeline companies, and equipment manufacturers. It's not glamorous, but in 10 years, it might be the best decision you made. Healthcare, the unstoppable demographic wave. Now let's talk about healthcare, because what's happening in healthcare is even bigger than energy, and most people are positioned completely wrong for it. Here's the simple math. 10,000 Americans turn 65 every single day, every day. That's been happening since 2011 when the first baby boomers hit 65, and it's going to continue until 2030. By 2030, 1 in 5 Americans will be over 65. By 2040, it's 1 in 4. You know what happens when people turn 65? They start consuming health care at 3 to 5 times the rate of younger people. More doctor visits, more medications, more surgeries, more chronic disease management. This isn't speculation. This is guaranteed to happen. These people are already alive. They're going to age. And when they age, they're going to need health care. Health care spending in America is already $4.5 trillion per year, about 18% of GDP. I expect that to grow to $6 trillion to $7 trillion by 2030. That's an additional $2 trillion to $3 trillion flowing into this sector. Now, where's that money going? Let me tell you where I'm watching. First, pharmaceutical companies with strong pipelines in chronic disease management. I'm talking about diabetes, heart disease, obesity, Alzheimer's, cancer. These diseases affect older populations disproportionately. The drug companies that have the best treatments for these conditions are going to print money for the next 20 years. Look at what happened with GLP-1 drugs like Ozempic and Wegovy. These drugs treat diabetes and obesity, and the companies making them, Miners, Novo Nordisk, and Eli Lilly, have seen their stock prices triple because demand is so overwhelming. That's the kind of opportunity I'm talking about. Find the companies with drugs that millions of aging Americans will need to take every day for the rest of their lives. Second, medical device companies, hip replacements, knee replacements, cardiac devices, surgical equipment. As people age, these things wear out. They need to be replaced or repaired. Companies like Stryker, Intuitive Surgical, Boston Scientific, they're going to see steady 8% to 10% annual growth just from demographics. Third, healthcare services. This is the biggest opportunity that nobody's paying attention to. As people age, they need help managing their health. They need home health care. They need dialysis centers. They need outpatient surgery centers. They need primary care doctors who can coordinate all their specialists. The companies that can deliver health care efficiently outside of expensive hospitals are going to dominate. United Health Group gets this. They've built a massive business in providing care directly to patients through their Optum division. They're essentially becoming a vertically integrated healthcare company. They insure you, they deliver your care, they fill your prescriptions. That model is the future, and companies that execute on it are going to generate returns of 12% to 15% annually. Now, I know healthcare stocks seem expensive. Many are trading at 20 to 25 times earnings. But here's the thing, they're earning 15% to 20% returns on equity. They're growing earnings at 10% to 15% per year, and they have demographic tailwinds that are absolutely guaranteed. If you can find a healthcare company with those characteristics at 20 times earnings, that's actually not expensive. That's reasonable for a high-quality, fast-growing, demographically favored business. I would have 25% to 30% of my portfolio in healthcare, split between pharmaceuticals, medical devices, and healthcare services. This is as close to a sure thing as you'll find in investing. Financial technology, the invisible revolution. Now, the third sector is going to surprise you. It's not artificial intelligence. It's not semiconductors. It's not social media. It's financial technology. And I don't mean crypto. I think crypto is garbage. I mean the infrastructure that's quietly taking over every financial transaction in the world. Let me explain what I'm seeing. Every time you tap your credit card, swipe your phone to pay, send money through Venmo, buy something online, there's infrastructure in the background processing that transaction. And the companies that own that infrastructure are making money on every single transaction. Think about Visa and MasterCard. They don't lend money. They don't take credit risk. They just process transactions and take a tiny fee, usually 2% to 3% of the transaction value. Here's the beautiful part. Their incremental cost to process one more transaction is essentially zero. It's all software and networks that are already built. So as digital payments grow, almost all of that growth drops straight to profit. And digital payments are growing everywhere. In America, cash transactions have dropped from 40% of all payments in 2012 to less than 20% today. Globally, we're still in the early innings. Billions of people in Asia, Africa, and Latin America are just starting to use digital payments. Visa and MasterCard process about 700 billion transactions per year globally. I think that number goes to 1.5 trillion to 2 trillion transactions by 2035. And they'll make money on every single one. Their returns on equity are 40% to 50%. Let me repeat that, 40% to 50% returns on equity, sustained year after year. You don't find that anywhere else in the economy. But it's not just the payment networks, it's the entire ecosystem. Payment processors like Block are giving every small business the ability to accept digital payments easily. They're taking a small cut of trillions of dollars in small business transactions. Firms like Fiserv and Fidelity National Information Services run the behind-the-scenes software that banks use. Every bank payment, every ATM withdrawal, every direct deposit, these companies are processing it. Then you have companies like PayPal and its Venmo app changing how people send money to each other. Money transfer companies like Wise and Remitly are taking over the international money transfer business from Western Union and MoneyGram. All of these companies share similar characteristics. High gross margins, 60% to 80%, low incremental costs, massive network effects, and growth rates of 10% to 20% per year. Here's what most people miss. This isn't a winner-take-all market. The payment ecosystem is huge and growing. Multiple companies can thrive simultaneously because they serve different customer segments or different parts of the transaction chain. Visa and MasterCard dominate credit and debit cards. PayPal dominates online checkout. Block dominates small business payments. Wise dominates international transfers. They're all winning. And here's the kicker. None of these businesses require much capital. They're not building factories. They're not buying inventory. They're running software and networks. That means they generate enormous free cash flow, which they return to shareholders through dividends and buybacks. Visa and MasterCard each buy back 2% to 3% of their shares every year, which alone gives you 2% to 3% annual returns before any business growth. Add 10% to 15% earnings growth, plus 2% to 3% from buybacks, and you're looking at 12% to 18% annual returns from these businesses. The risk? Regulation. Governments don't like the fact that two companies, Visa and MasterCard, control so much of the payment infrastructure. There's always risk of regulations that cap fees or force more competition. But I've been watching this for 20 years. And despite all the threats, these companies keep growing and keep printing money. Their moats are just too wide. The network effects are too strong. I would have 15% to 20% of my portfolio in financial technology companies, weighted toward the payment networks, Visa, with smaller positions in processors and disruptors. How I'm thinking about timing. Now, you might be asking, Warren, if these opportunities are so good, why aren't you buying heavily right now? Why are you sitting on $325 billion in cash? Great question. Let me be honest with you. These sectors are attractive. The long-term stories are compelling, but valuations matter. I'm not going to overpay just because the story is good. Utilities are reasonably priced right now. Many are trading at 15 to 18 times earnings with 3% to 4% dividend yields. That's fair value, maybe slightly attractive. I could buy them today and feel good about it. Healthcare stocks are mixed. Some pharmaceutical companies are reasonably priced. Medical device companies are a bit expensive, but not outrageously so. Healthcare services companies like United Health are fairly valued. Financial technology companies are the expensive part. Visa and MasterCard are trading at 28 to 30 times earnings. That's a premium valuation. They're great businesses, but I'd be more comfortable at 22 to 25 times earnings. So here's my strategy. I'm watching and waiting. If we get a market pullback of 15% to 20%, which we will eventually, we always do, these sectors are where I'll deploy capital aggressively. A 20% market pullback would bring utilities down to 12 to 14 times earnings. Healthcare stocks would be at 16 to 20 times. Financial technology would come down to 23 to 25 times. At those levels, I'd be buying heavily. But even at today's prices, if I were a regular investor building a 20 or 30-year portfolio, I'd be comfortable accumulating positions slowly in all three sectors. The key is you're not trying to time the bottom. You're building positions over time, and you're holding them for decades while these secular trends play out. The portfolio allocation I'd consider, if I were building a portfolio from scratch today, here's roughly how I'd think about allocating across these three sectors and the rest of the market. 25% in energy infrastructure, split between regulated utilities, 15% pipeline companies, 5%, and equipment manufacturers, 5%. 30% in healthcare, split between pharmaceuticals 10%, medical devices 10%, and healthcare services 10%. 15% in financial technology, split between payment networks 10% and processors, disruptors 5%. That's 70% in these three high conviction themes. The other 30%? I'd keep 10% in cash or treasury bills for flexibility, 10% in an S&P 500 index fund for broad diversification, and 10% in a handful of individual companies. I understand well that don't fit these categories. What this means for your portfolio, look, I'm not telling you to copy my thinking exactly. Your situation is different from mine. Your time horizon might be different. Your risk tolerance might be different. But I want you to understand the lens through which I'm viewing the market right now. I'm not looking for companies that might triple next year. I'm not trying to find the next Tesla or the next NVIDIA. That's not how I've built wealth, and it's not how you should try to build it either. I'm looking for boring, predictable businesses with strong competitive positions that are positioned to benefit from massive, unavoidable trends. Aging demographics aren't going away. Energy infrastructure needs aren't going away. Digital payments aren't going away. These are 20-year trends, and the companies positioned correctly are going to compound returns at 10% to 15% annually for decades. That might not sound exciting compared to crypto or meme stocks or whatever's hot this month, but let me tell you, 12% compounded for 20 years turns $100,000 into $965,000. That's life-changing wealth, built slowly and steadily. The key is you have to have patience. You have to be able to hold through volatility. You have to resist the temptation to sell when things get scary and to chase when things get exciting. I've been doing this for 70 years. The strategy hasn't changed. Find good businesses, buy them at reasonable prices, hold them forever, don't do stupid things.